Thank you for joining me for a discussion about taxes and politics for 2026, an update on legislation changes, geopolitics, and midterm election years presented by Pathfinder Wealth Consulting. If you're not familiar with me, my name is Alex Greer. I'm an associate wealth advisor and certified financial planner with Pathfinder in our Cary, North Carolina office. I'm really excited to run through the presentation today. Before we dive in, I do want to note that all of the information that we're going over is general information and it's not a specific recommendation for your unique financial circumstances. If you have questions about how the information that I go over today relates to your unique plan, please reach out to one of our wealth advisors. We'll have contact information at the end of the presentation. Now, before we dive in, I do want to run through our agenda. I'm going to start by talking about politics and really setting up the midterm election that is set to take place in November of 2026. We're going to look at Congress and where we sit heading into the midterm election, and also what history tells us about previous midterm elections and what may happen this November. After we talk about that, we are going to talk about markets and the economy. We'll talk about midterms in the market and the impact that midterms have on the market. We'll also talk about recent geopolitical events and some of the impacts that that has had on the market. After we've run through all of that, we're going to finish the conversation by talking about taxes. And primarily, we're going to focus that conversation on the One Big Beautiful Bill Act that was signed into law in July of 2025. We're going to go over some of the key tax provisions and what that's meant for tax filing in 2026 and what it'll mean in the coming years. So let's go ahead and get started, and we're going to start with the current political landscape. I'm going to start by talking about the Senate. The Senate right now is under Republican control. The Senate is comprised of 53 Republicans, 45 Democrats, and 2 independents who caucus with the Democrats. Now, if we look at the Senate, 33 of the 100 seats in the chamber are up for election. If we think back to our U.S. history class or our U.S. government class in high school, the Senate has 100 seats. Every 2 years, 33 of those seats are up for re-election, so senators serve 6-year terms. Now, of the 33 seats in the chamber that are up for election this year, Democrats control 13 of those, and Republicans control 20. Republicans can only lose 2 net seats and retain a majority in the chamber. Democrats need to gain a net of 4 seats to win a majority in the chamber. As of March 24th, 11 U.S. Senate incumbents, 4 Democrats and 7 Republicans, are not running for re-election in 2026. This is really important, and we'll look at some of the data around this when we get to a few slides later in the presentation. There will be 2 special elections happening on November 3rd. These special elections will fill the last 2 years of the 6-year terms to which Marco Rubio and J.D. Vance were elected in 2022. Now that we've talked a little bit about the Senate and where we sit there, let's go ahead and move to the House. The House is also currently under Republican control. Right now, there are 217 Republicans, 214 Democrats, 1 independent, and 3 vacancies in the House. All 435 districts are up for election this year, and 54 incumbents are not running for re-election. Of the 54 incumbents not running for re-election, 21 are Democrats and 33 are Republicans. So looking at the House and the Senate, they are both under Republican control, but they both have a very, very narrow lead heading into November. And now I want to talk a little bit more about what history tells us about what may happen in these elections. So this chart here gives us a lot of data around congressional incumbents who won and lost re-election each year. This chart goes all the way back to 1988 and runs through 2024. And so, it may be a little bit difficult to see some of the numbers here, but really the important thing to note is the overall trend. The blue part of each bar graph are incumbents who won re-election, and then that orange or peach color, that's each year the incumbents who lost re-election. And so very clearly what you can see here is a trend that congressional incumbents typically win re-election if they are running. It's very, very rare to see an incumbent actually lose re-election if they choose to run. And so going back to our previous slides and noting the specific amount of incumbents who are not running, Those races where there's no incumbent involved is typically where we'll see seats change hands and where gains or losses can happen from party control. So this is a really, really interesting slide looking back at data over a long time period. And just some overall historical trends to review. The president's party typically does lose seats in a midterm election year. History is not kind to the sitting president's party. We looked back at data, and from 1934 to 2018, the sitting president's party loses on average 4 seats per election cycle in the Senate and 28 seats per cycle in the House. I saw another stat that I thought was really, really interesting. If you go back to 1902, only 4 midterm election cycles have seen the sitting president gain seats. That happened in 1902, 1934, 1998, and 2002. 2 of those were Republican, and 2 of those were Democratic majorities. So over that long time period, all the way back to 1902, there have only been 4 midterm elections where the sitting president's party has actually gained seats. Now that we've set the stage for midterm elections coming up in November of this year, I do want to take a look at the markets and the economy. And really, I'd like to start this conversation by going back to midterm elections and just looking long-term at what midterm elections have meant for the market. Historically, midterm years have been challenging for stocks. This chart here in front of me looks at S&P 500 performance during the presidential cycle. This goes back to 1950 and runs through November of 2025. So very, very accurate, up-to-date numbers here, going all the way back to 1950, basically 75 years of data. And so what you can see here, the blue line is the average return for each year in the presidential cycle. You can see that the strongest year is actually the pre-election year. And you can see that the weakest year for average return is midterm years. Midterm years have averaged a modest 4.6% gain. And what you can also see here is that they have the biggest drawdown during midterm years. There's an average maximum drawdown of about 17.5% during midterm years, which is a bigger drawdown than any of the other years in the election cycle. And so what you can also see here is that the little diamond on the screen there, the realized volatility, that's also highest in midterm years. So we typically see more ups and downs in midterm years. The market really, really likes certainty. And political uncertainty runs pretty rampant in midterm years. And so the market does not like that. Now, what you can see is that as soon as midterms are finished and the market feels like it has more certainty priced in, those pre-election years, the years after the midterms, are typically the strongest market return. And one last thing I'd like to leave you with on this slide before we move forward is that while midterm years have had the lowest average annual return, they still do average 4.6%, which is positive return. So when we say that midterm years are typically the worst year for stock performance, it still has averaged a positive return during midterm years. It's just not as strong as the other years in the election cycle. So now that we've talked about midterm elections and some of their impact on the market, we're going to move forward and talk a little bit about some geopolitical events and what impact that has had on markets. Quick timeline here. Tensions escalated at the end of February with back and forth airstrikes, and by early April we saw a temporary ceasefire announced. Currently, there are possible resolutions to the conflict that have been thrown out. There's been a number of statements in the news going back and forth on peace talks happening or not happening, but we currently don't know how long this conflict is going to last. This situation developed quickly, and we don't know exactly what it's going to look like moving forward. Like most things, trying to predict what comes next is nearly impossible. So instead of trying to predict what may happen, I really want to look at some of the early data that we've gotten back on the economy and markets and what the impact on the war has been to the markets. So looking at these charts here, they're going to give us a little bit of an overview of some of the early implications of the current conflict in Iran. You can see from the chart on the left, the Strait of Hormuz is one of the most important shipping lanes in the world. A huge percentage of global oil and energy flows through that single choke point. The US and Iran have had a number of competing blockades, which has impeded the shipping through this vital Middle Eastern waterway. And I think it's also important to know that While it is a vital choke point for global energy flows, there are things other than just oil going through. It's a key artery for industrial inputs like petrochemicals and fertilizers. So, because of that, disruptions can ripple across global supply chains. So, it's not just oil that's not getting through, there are other key pieces of global supply chains that are getting held up in these blockades. On the right, you can see how some of that delay is showing up. Energy prices moved up quickly, with gas and diesel rising significantly since the conflict began. That chart there on the right is dated as of the end of March 2026, and you can see a sharp increase in the price of gasoline and diesel. The key takeaway here is that while geopolitical tension may not impact us directly, it definitely shows up in oil prices, and that feeds into inflation, which is what the Federal Reserve and markets are watching closely. Looking here at that and looking at inflation, on the left chart here, you can see inflation had been coming down, but we've seen that stall, mostly due to higher oil prices keeping pressure on the system. You can see that we've kind of stayed flat, if not increased a little bit. This data is as of the end of March. But really on the right, we can see the expectations for interest rates change. Earlier this year, markets expected multiple rate cuts from the Federal Reserve, but now those have been scaled back, perhaps just one later in the year. In the end, because of the conflict, interest rates will likely stay higher for longer, whereas previously they were projected to cut. Inflation isn't fully under control yet, and so the Fed is staying cautious. With a new chairman of the Federal Reserve taking over, we can expect different metrics for rate changes going forward. So this will be really, really interesting to monitor, and this is really one of the key impacts of the war in Iran. We have seen a lot of volatility so far year to date, but volatility is not the same as risk. You can see a quote on the screen here. If you're nervous about volatility, just wait a few days. And this is really true. Volatility can and does move that quickly. And so I do want to talk a little bit about key takeaways from history and what history can tell us about where we sit currently. When wars begin, markets can be volatile in the short term. You'll typically see pretty quick ups and downs early on. This chart here shows wars in the stock market, and it shows trading days relative to war start. So you can see how the market was performing 100 days prior to that conflict starting, and then we actually run out 10 years afterward. And this is a number of different wars, and really the trend that you see here is that over time, markets have generally moved higher regardless of conflict. If you look out 1, 5, and 10 years, returns have typically been positive, especially when you get out over a longer period of time, like 10 years. Geopolitical events can create short-term uncertainty, but they haven't historically changed the long-term direction of the market. This is another chart to illustrate that and talk about geopolitical volatility. And I like this one a lot because it doesn't just look at wars, it looks at just overall geopolitical events. Geopolitical events often generate alarming headlines, but markets have absorbed these shocks more resiliently than expected. In the short term, you do see volatility around the events. But when you look 1 year, and especially 3 years out, returns have typically been positive across most periods. So the key takeaway from these two charts and really what we're talking about is that while these events can feel significant in the moment, and they certainly are, we're just talking about the market impact of the event, not the humanitarian side. Historically, the events have not changed the long-term path of the market. And as we talk volatility, I do want to put volatility in context. I think the best way to do that is to look at the volatility index, or the VIX. So a reading of over 30 signals increased volatility. If you see this index over 30, that means that things have gotten more volatile. And while we have gotten close to that this spring, we actually haven't even gotten close to where we sat last April when all of the tariff news was in the headlines and kind of wreaking havoc in the markets. We showed this chart last year, and you can see it in April 2025. At that point, we got to a high of 52. And while volatility has picked up with the current conflict, it's been much more contained. The recent high was around 31. So while the headlines may feel similar to this year, market reaction has thus far actually been more measured. And that's a good sign for now that investors are absorbing uncertainty without the same level of stress that we saw a year ago. And so, this is a great chart that we always like to look at anytime volatility increases. This chart shows what has happened historically in years of high volatility, marked by single-day swings in the market of 2% or more. So if the S&P 500 increases by 2% in a day or decreases by 2% in a day. And really what you see here is that in 2025, we had 13 days where the volatility was up or down 2% or more. So far year to date, we had 2 through the end of March. Since March 31st, we've had 1 more. So we're at 3 days of 2% or more volatility year to date. And what we really see is that in years with fewer than 10 of these days, the average market returns are close to 20%. When we have years that have 10 or more of those days in the year, there's an average return of under 2% in the U.S. stock market. Now, that doesn't always hold true. Last year we had more than 10 days, and the U.S. stock market was still higher than 2%. But typically, years with less volatility is a good thing for overall market returns. An important reality about markets is that the best days often come right after the worst days. Over the past 20 years, 24 of the 25 best days happened within 1 month of one of the worst days in the market. So if you try to get out during volatility, if you try to trade and avoid the ups and downs, you risk missing the rebound, and those rebounds are where a lot of long-term returns come from. There's a great example actually from last year in 2025. On April 4th, 2025, the S&P 500 dropped 5.97%, which was the largest one-day percentage drop since 2020. It was also preceded by a 4.84% drop the day before. A few days later, on April 9th, the S&P 500 went up 9.52%, which was the largest one-day increase since 2008. If an investor had moved to cash after the down day on April 4th, they would have missed a 9.52% return day just 5 days later, which was the best day in the markets in almost 20 years. And then here's one more chart just to talk about volatility and really talking about being a long-term disciplined investor. Staying invested is better than timing. And really what this shows is that missing top performing days can hurt your return. And so this is just a hypothetical investment of $100,000 in the S&P 500 from 2005 to 2024. And what you can see is that if you made that investment at the beginning of 2005 and you just stayed invested the entire time, at the end of that period, your initial $100,000 investment would be just over $717,000. Now, to the right of that $717,000 graph, you can see that if you just missed the 5 best days in the market, your return would be almost cut in half. If you missed just the 5 best days, you'd have just under $453,000. And that trend continues, the more days that you miss that are good in the market, to where ultimately, over that 20-year period, if you missed the best 25 days in the market, your return or your end of investment value would be $158,000 instead of the $717,000 that you would have had if you just stayed invested. So it's really, really important not to try to time the market, but to stay disciplined, stay invested, and let the market do its thing long term. So geopolitical threats are always out there, and these issues could lead to volatility in the markets. But they're very, very unpredictable. It's impossible to know what's going to come next. It's not prudent to make investment decisions based on geopolitical events. We always say what's important is to make sure that your portfolio is invested and allocated according to your needs so that when these events happen, you're able to ride out the storm and not have to make drastic emotional changes. Now that we've talked a little bit about the markets, I do want to shift gears and talk about taxes. As I said earlier, we're going to spend our time today talking about the One Big Beautiful Bill Act. That was signed by President Trump on July 4th, 2025. It's 330 pages of legislative reform. I'm not going to run through all of those today. This video would be hours long if I were to do that. And so really what I want to look at is some of the key tax provisions and the permanence of key Tax Cuts and Jobs Act provisions, and then several new and enhanced tax breaks. So before we dive into what is in the bill, I want to talk about what's not in the bill. These are all items that were potentially floated or things that people thought may be in legislation. There were no changes to the Social Security program. There was no change to health savings accounts. There were no restrictions to state level pass-through entity taxes. There were no changes to capital gains tax rates. Roth conversions were not limited, and there were no wealth tax or net worth tax proposals included in the One Big Beautiful Bill Act. So the first thing that happened here, individual tax rates. There was a permanent extension of the tax brackets that took effect in 2018 under the Tax Cuts and Jobs Act. So before the One Big Beautiful Bill Act was signed into law, our tax brackets were actually set to expire and go back to the pre-TCJA brackets. And so really what you can see here is that our current tax brackets are now permanent. I will make the small note that, like anything in Washington, everything is permanent until it gets changed with future legislation. So when I say permanent, I just mean that there is no set date where these are going to change or revert back in the future. So right now, we do still have our progressive tax bracket system. The lowest bracket, bracket 1 there, starts at 10%. And you can see that we gradually increase all the way to the highest income tax bracket, which is at 37%. And so looking more specifically and looking at 2026 numbers, these are the actual brackets themselves and the dollar amounts that those brackets include. So you can see on the left we have single filers and on the right we have joint filers, and you can see the different brackets amount and the taxable income amounts within each bracket. There were no major changes here. These do adjust for inflation, so year over year we typically see them increase over time. Now, I want to talk a little bit about the standard deduction. The standard deduction was doubled under the Tax Cuts and Jobs Act, and that was permanently extended under the One Big Beautiful Bill Act. Also, personal exemptions were suspended and are no longer in use. And so what you can see here for 2026, the standard deduction for a single filer is up to $16,100. For joint filers, it's up to $32,200. There is still the child tax credit maximum. That's $2,000 for single and joint filers. And then there are child tax credit phase outs in place at $200,000 for single filers and $400,000 for joint filers. Now, one of the new key items in the One Big Beautiful Bill Act is the temporary senior deduction. It started last year in tax year 2025, and it runs through tax year 2028. So it's an additional $6,000 deduction per individual over age 65 or age 65 plus. Now, for a married couple filing jointly, where both spouses are age 65 or up, it's up to $12,000. It's not inflation indexed, so it's going to be those amounts for the entirety of the program, and it's available for standard or itemized deductions. So if you itemize your deductions, you still get to take this, and if you take the standard deduction, you also get to take it. It does phase out at 6% of a modified adjusted gross income above $75,000 for single filers and $150,000 for married filing jointly. I'll run through some examples that show how that phase out actually operates on the coming slides. Now, it's fully phased out and not in effect if you have a modified adjusted gross income of above $175,000 as a single filer or above $250,000 as a married filing jointly filer. So let's go ahead and dive into a couple of examples here to run through how that senior deduction phase out actually works. What you can see here is that we've got the 2026 standard deduction. And what we're looking at here on the left is a single filer age 67 who has a modified adjusted gross income of $70,000. On the right, we're looking at another single filer who's also age 67, but there's a modified adjusted gross income of $100,000. And so for both of these filers, the base standard deduction is $16,100. There is also an age-based deduction of $2,050. That was in place before the One Big Beautiful Bill Act and remains in place now. And then in addition to this age-based deduction, there's also the temporary senior deduction. So you can see that $6,000 reduction applied in both cases. Now, for the filer that has a modified adjusted gross income of $70,000, They are not at the phase-out range. They've earned less than $75,000. And so their total standard deduction is just the total of those three numbers, $24,150. Now, for our filer who earned $100,000, they are in the phase-out range. So the AGI is $100,000, and that phase-out amount is $75,000. So the excess AGI is $25,000. 6% of that excess is $1,500. So you can see there that $1,500 is subtracted from the senior deduction. And so the total standard deduction for this filer is $22,650 instead of the $24,150 amount for the filer that's below that phase-out range. We have another example here. This is for a married filing jointly couple, and the numbers are different, but the concept remains the same. So you can see we've got a couple that earns less than the phase-out amount on the left and a couple that earns more than the phase-out amount on the right. And so again, these standard deduction numbers are different because this is married filing jointly. And then you can see there is the age-based deduction as well. That new temporary senior deduction is in place. And the couple on the left, since they earned less than the phase-out amount, they get to add up those three amounts. The couple on the right, they have to take their adjusted gross income, subtract the phase-out amount, and then apply 6% of that excess AGI, so they have a $3,000 reduction. Again, the numbers are different here, but the concept overall is the same. And then again, once you get over certain income amounts, there is no senior deduction available. So a key planning point for individuals that are age 65 or older is to see if it's possible to keep your income below those phase-out ranges and take advantage of the full standard deduction. Now, some other key provisions from the One Big Beautiful Bill Act is the estate tax exemption. And so much like the income tax brackets, the Tax Cuts and Jobs Act doubled the estate tax exemption from $5.6 million to $11.2 million per person. That had grown up to about $14 million. And so at the end of 2025, that was scheduled to revert back to about $7 million. But with the One Big Beautiful Bill Act, it was permanently set at $15 million per person. This is indexed for future inflation, so it will continue to go up. And it actually prevented the sunset and slightly increased the exemption. So practically speaking, for a single filer, you can transfer up to $15 million through an estate and not owe any federal estate tax. That is doubled for a couple. So a married couple can transfer up to $30 million at this point, have a $30 million estate, and not be subject to federal estate taxes. It is important to note that some states do have lower estate tax exemptions, and so depending on where you live, you may still have some estate tax considerations to take into account. Now, the last piece that I want to talk about today is something that we've gotten a number of questions about, and that's Trump accounts. This is a new retirement savings vehicle for children under age 18. Contributions grow tax deferred. Now, the contributions are not tax deductible, so there's no immediate tax break. But once the money's in the accounts, it does grow without any tax year over year. The big thing about these is that there's no earned income requirement to contribute. Previously, there were things like minor IRAs and minor Roth IRAs, but for children to contribute to those accounts, they had to have earned income. Trump accounts require no earned income to contribute to them. And also, there's no income limit. Everyone is eligible that has a child below age 18, so no matter what the family income situation is, contributions can be made to the accounts. These accounts, they are able to be opened now, and really the contribution window is actually coming up soon. Starting on around July 1st of 2026, contributions will be able to be made to the accounts. So let's talk a little bit about those contribution rules. The annual contribution limit is $5,000. That does index for inflation, but right now you cannot put more than $5,000 in the account in any calendar year. This does not count towards the IRA contribution limit. So if you have a child and the child is working a job and is contributing to a minor IRA, they can contribute to the minor IRA and they can contribute to a Trump account. And those two numbers, they do not overlap. Family and friends can contribute up to $5,000 per year. Again, it's not tax deductible. Employers can actually contribute up to $2,500 per year. That does count towards the total $5,000 limit, and that amount is excluded from employee income. Governments and nonprofits have no stated limit and does not count towards the $5,000 aggregate limit. That's an area that we're awaiting clarification on as far as how that's written and what that actually looks like in practice. Now, there is a pilot program credit for Trump accounts, and this is really, really important for children born between 2025 and 2028. So parents must opt in and they must choose to take advantage of it. But for children born in that time period, the Trump account can be funded with a $1,000 government credit. Children born before 2025 can still open a Trump account, but they're not eligible for that pilot program credit. So we are looking at this. There actually is a website that you can go to make the election. Otherwise, you can also make the election via a tax form. And 2025 births are eligible, but contributions will not be made until at earliest July of 2026. And so the Trump accounts do have some investment rules. These are going to be U.S. equity index funds, so mutual funds or ETFs. These are not going to be individual stocks. So no one is going to be buying Microsoft stock or Apple stock or anything like that in these accounts. They're going to be, sector, things like large cap growth, mid cap growth, etc. No leverage is allowed in the accounts. These are not designed for super aggressive investing or day trading or anything like that. And expense ratios on the funds are capped at 0.10%. So really, these look like they're designed to be long-term, low-cost investments that are pretty diversified. And now it is important to note too the distribution rules with Trump accounts. There are no withdrawals permitted before age 18. So you can't pull this money out to pay for private K through 12 schooling. You can't pull it out for any expense before the child is age 18. And at age 18, withdrawals are taxed like an IRA. So qualified distributions, there are some things that money can be taken out for prior to retirement age. Things like college expenses, up to $10,000 for first-time home purchases, or business startup costs. Now, there's no penalty on those distributions, but there will be income tax owed on those. And if someone makes a non-qualified withdrawal before age 59 and a half, they owe the tax plus a 10% penalty. After age 59 and a half, distributions are permitted for any purpose. It's important to note that for a child born in 2025, you're pushing out very, very far, almost 60 years before complete distributions are allowed, distributions for any purpose. So when thinking about these accounts and how they fit in, they may make sense, but like anything, it's important to think about what your specific goal is and what you're trying to accomplish when integrating these into your financial plan. And so as we wrap up the presentation today, I just want to leave you with a few key takeaways. I think it's really, really important to stick to your plan. Remind yourself of your long-term goals and the financial plan that you've set in place. It's important to base your decisions on your financial objectives rather than short-term political events. Also, staying diversified. A well-diversified portfolio can help mitigate the impact of any single event, including elections or geopolitical events. And ultimately also avoid emotional decisions. It's important to not make knee-jerk reactions based on short-term news or speculation. Avoid market timing. Trying to time the market based on news or election results is really, really difficult and often leads to suboptimal outcomes. It's important to consider your risk tolerance. If you find yourself becoming excessively emotional or anxious about market volatility during election seasons, it may indicate that your portfolio's risk level is too high for your comfort. And then also, if necessary, turn off the news. If the constant barrage of political news and updates is causing you undue stress, take a step back. Engage in activities that help you relax and maintain perspective on the bigger picture. Thank you so much for listening to the presentation today. Like I mentioned at the beginning, nothing that I said today is a specific recommendation. If you would like to reach out or if you have questions for us, please reach out to your advisor. If you are not working with us currently, I've got our office contact information here. You can see our office phone numbers. We are more than happy to get connected. So thank you so much for the time, and I hope you have a great day.